I'm Matt Bishar with REIT.com here in Boca Raton, Florida for REITWise 2014, NAREIT's Law, Accounting, and Finance Conference. I'm joined by Hans Nordby, Chief Economist with CoStar. Hans, thanks so much for joining us again.
Not at all. Thanks for having me back.
Now, as you look at the REIT market, which sectors do you expect to outperform over the next year or two, and why?
Well, Matt, we focus on real estate fundamentals. So the public versus private market thing I'm going to set aside and just talk about what drives the commercial property types. When we look at the four major food groups in commercial real estate, industrial, multifamily, office, and retail, we think industrial is going to be the place to be over the course of the next year to 18 months.
And what is driving the industrial sector?
Well, driving is exactly the right way to put that. So what's underneath if you're a geeky economist like me? So, well, first of all, occupied warehouse space has a 93% correlation in this country with GDP growth. So the economy is growing, and that's a good thing. And if you look at the pieces of the economy that are growing, there are things that are good for growing demand for distribution space. And of course, a lot of the biggest industrial owners in the country are REITs. So the housing market. The housing market prices are up, and that supports new construction. So home construction doesn't follow a straight line, but it is solidly up the last 3 years. You build new homes, you need more garden hoses, you need to go to Home Depot, you need to get more shingles to build the home. So that's all very good in terms of demand through the distribution chain. So GDP growth, the housing market, retail sales are pretty strong, and also on the margin, it looks like offshoring is going to be taking a breather for a while. The U.S. has a structural advantage in energy prices that really aids the manufacturing sector, and that's good for industrial demand. You put all those fundamentals together with the fact that there is far too little supply underway in the industrial sector, and you've got the recipe for very good fundamentals. Vacancy rates today in distribution real estate are lower than they were in 06. They're the lowest since 1999. It's too tight. So we've got to get a lot of these REITs out there building some more buildings.
How do you expect demand for commercial real estate to change going forward?
Well, that's a great question. So in terms of demand, there are a couple of big mega trends at work. Now, we all talk about the millennials, the echo boomers, these 20 to 25-year-olds that are changing the world, and that's appropriate. They do have a big impact on the market. And what we've seen there, let's start with office. So in office, the millennials, they're used to working in a collaborative work environment. Their idea of privacy has a lot more to do with putting headphones on than it does with closing an office door. They aren't seeking big office spaces. They're used to working together closely at a large table like they were in college, and there's a lot of them. And corporate America likes the collaborative environment, and they like having fewer square feet per worker. So you put these things together, and that's something that's here to stay. But here's something that goes with it that I think we're just starting to get a handle on now, which is the trend in square foot per worker may have stopped trending down on average. Here's what's going on, is the best collaborative space has a lot of shared space for dining, for meeting rooms, things of that nature, and that takes space too. Also, if you look at the demands, and this is another thing with space, is that it's about quality, okay? So if you take locations of these buildings, so far it's about either best location or best building. Well, as we don't have a lot of growth in the college-educated population, that's going to become even more important in order to attract talent. So that's another big trend that's going on right now, is the trend towards quality, and that's good for REITs, who are oftentimes developers, or they own better buildings in the best locations.
And lastly, I know as an economist, you're someone who enjoys spotting new trends. What is one trend that may be flying under the radar that you think could have a big impact on the industry in the years to come?
Working age population growth in this country, Matt, it's going to 0.22% in the year 2022. And that's not maybe, okay, we could radically change immigration policy and increase that a little bit, but basically the way demographics work is you can spot them 10 years out. If you're a commercial real estate investor, you're probably looking at a 7 to 10 year hold. Okay, 7 to 10 years from now, working age population growth is next to nothing. What does it do for your exit? Okay, now that's the average. Now the speech I'm giving later on today here at NAREIT over lunch is entitled, "On average, the Earth is 18 inches underwater." Right? The average doesn't tell you the whole story. Investors can do something about that in terms of the class of building they're in, the submarket in which they're located, and the cities in which they invest. So that average doesn't necessarily mean where you'll wind up as an investor, but it has a huge impact on individual investments that you will make. So for example, if you're in a city with good demographic trends, a fairly educated population, good in-migration, good weather, doesn't hurt, and a low taxation and regulation regimen, you'll probably continue to have people move to town. You know, that smells like Charlotte and Houston, Dallas, Phoenix. Now, these are low barrier to entry markets, right? It was a different investment dynamic, but the demand side is probably less in danger. If you have other markets like Boston or New York, which are big investor favorites, you know, it could be that we have enough increase in the college-educated population and the best locations for those. But then you've got some other metros like Pittsburgh. Well, a little bit tougher to figure out. So this decrease in working age population will also increasingly emphasize quality, because when it's tough to get the best people, you better have the perfect location or the perfect building. Because interestingly, total compensation per employee, which is office space, is at its all-time low today. And when the labor market gets even tighter, you won't care what the rent is. So if you own the best building, the best location, this might end well, but you better get ahead of it.
Hans, thank you so much for your insights.
Not at all. Thank you.
For more on this and other REIT news and analysis, be sure to visit REIT.com.